As you can see, personal finance certainly matters when it comes to your own leadership and how your organization conducts itself. This is quite an extensive conversation, and we can discuss this further in the Q&A, but we're going to dive back into the organizational aspects of financial management. When starting an organization or examining established organizations, it's important to consider the following steps. Identification of programs. Relatively permanent organizational activities or services designed to accomplish specific objectives. What is it that the organization offers, and who is the target population being served? The creation of a program structure. This includes major services and activities provided by the organization. Next is the assignment of program managers. Duties of assigned program managers should include both programmatic and financial responsibilities. Next is the designation of responsibility centers. Programs can be designed or designated as an expense center, revenue center, profit center, an investment center, or a combination. And then we have ongoing financial analysis. Income for previous years is examined to identify the average revenue generated annually and compare it with the current year. Next, let's take a look at financial analysis. Generally accepted accounting principles are basic sets of rules governing how the financial records of a nonprofit organization are to be maintained as indicated by the Financial Accounting Standards Board. If you're not familiar with this, it's highly recommended that you do so when it comes to organizational financial management. IRS status, or Internal Revenue Service classification of a 501c3 1 through 15. In particular is something many of you are familiar with, but just in case this is new for anybody, nonprofit organizations recognized by the IRS are referred to as exempt because they do not pay federal income taxes on their earnings and have a specific set of rules on organizational activities. Something else to keep in mind for financial documentation and program development. And SFAS number 117. Or Statement of Financial Accounting Standards number 117 requires that all nonprofit organizations periodically prepare what it refers to as the general purpose external financial statements. To determine the financial health of a nonprofit organization, you need to understand its financial statements. Some nonprofits are required to publish a Form 990, which is a public document. You can request a free copy from the nonprofit or from the IRS or download a copy from a site like Charity Navigator or GuideStar. A SWOT analysis, or strengths, weaknesses, opportunities, and threats analysis, is a strategic planning technique used for formulating business development strategies. It involves assessing the present strengths and weaknesses of a company, as well as the opportunities and threats posed by the external environment. In financial management for organizations, a SWOT analysis is conducted to determine whether the intended market strategy is feasible from perspective of available resources. The result will help you gain insight to how to best position yourself in your target market, a key part of a successful marketing plan. A financial management for organizations SWOT analysis allows an organization to understand its internal environment at both the micro level, existing assets, and macro level pressures from the external environment. It is based on a marketing management philosophy that views environmental analysis as critical to any business strategy. For financial management for organizations, marketing managers must consider all factors that may impact its operations and performance to identify strengths, weaknesses, opportunities, and threats, which will contribute to a comprehensive marketing plan. A SWOT analysis is typically composed of 4 components as the graphic depicts, starting with strengths, internal factors providing organizations with a current competitive advantage; weaknesses, internal factors that place organizations at a disadvantage compared to competitors; opportunities, external factors representing an organization's next best chance for growth or improvement; and threats, external factors over which organizations may be impacted, especially via financial management and human resources. The following slides are for your information, and we don't need to read each slide one by one, but this is to give you a general idea of different ratios to consider in financial analysis and what your organization should be looking at when evaluating its financial health and sustainability. These ratios include current ratio, long-term solvency ratio, contribution ratio, programs expense ratio, general and management expense ratio, fundraising expense ratio, revenue expense ratio. But we'll take a look at each briefly so you can get an idea of what each equation looks like, and then we'll move on into budgeting. The current ratio is used to assess an organization's liquidity, which is the extent to which an organization's assets can be quickly converted to cash to cover operating expenses. Next, we have long-term solvency ratio. The long-term solvency ratio refers to the capacity in which an organization can pay its expenses, and the outcome should be 1.0 or higher. Anything less than 1 would indicate issues to long-term viability. Next, we have contribution ratio. It's used to determine overdependence on a main revenue stream, emphasizing the importance of diversifying those streams of funding in case a major funding source becomes unavailable in the future. Next, we have programs expense ratio. This can be used to help donors decide whether or not an organization is viable and efficient using the equation to determine an outcome of 0.6 or higher, and flexibility is given to new organizations with less than $100,000 in annual expenses. Next, we have general and management expense ratio. General and management expense ratio determines how much of the organization's expenses go to administrative costs. After that, we have fundraising expense ratio, which assesses overall fundraising costs and efficacy. After that, we have revenue expense ratio, which is used to determine if an organization is making money, losing money, or breaking even. In terms of budgeting, next we'll go over major budgeting systems, line item budgeting, performance budgeting systems, program budgeting systems, and comprehensive budgeting. What major budgeting systems indicates here is using a systems model that encompasses line item budgeting, performance budgeting systems, program budgeting systems, and comprehensive budgeting in a way that flows and how these systems impact one another. In this chart, you can see that line item budgeting is imperative to making and keeping an organization functioning and healthy. This directly impacts inputs, processes, outputs, quality of services, and outcomes, which lead to program and performance budgeting, leading back to inputs, processes, and line item budgeting in a cycle. This is an example of line item budgeting, how it relates to processes, to inputs, and answers the question, are organization and program expenses in line with the approved budgets? Performance budgeting systems are accomplished at the program level. It determines output, total program cost, and cost per input or unit of service, and should be well known by program managers and teams. Program budgeting systems allow for program management and staff to scrutinize total program costs and how it relates to performance numbers and cost, and could help make individual programs much more efficient. Finally, comprehensive budgeting takes all of these different means of budgeting and is incorporated into a single model. The first step for organizations is determining how effective their department is to create performance measures that are useful for decision-making purposes. Performance analysis refers to analyzing an organization's or individual's effectiveness at completing tasks or goals. Managers must be able to determine how their department is performing and if they are meeting the needs of the organization's mission and purpose. Organizations can create a performance analysis sheet that includes different options for measuring performance. Performance measurement includes the regular collection of reporting information about the efficiency, quality, and effectiveness of programs and the administration of an organization. Overall, your organization's performance analysis needs to include defining performance measurement, how performance measures are used, major performance measurement initiatives, output, quality, and outcome, and good performance measures. Cost analysis and differential cost analysis is what we can do with the aforementioned ratios. Nonprofits use financial statements differently from a division within a for-profit corporation or a government agency. The primary difference is that nonprofits have to raise their funds and have minimal resources of their own, while corporations and governments may be self-sustaining. Financial ratios are used in much the same way as they would be within any division of a company, but some additional ratios are related more directly to fundraising efforts, and that will also be discussed. After implementing the ratios, you can take a broader macro perspective when it comes to financial health and sustainability. Financial forecasting is the process of making predictions about the future, scenarios based on information and data that can be gathered in the present time period. Financial forecasts for nonprofit organizations use historical data to project future revenues and expenses to better understand the financial health of the organization and plan accordingly. Financial forecasts may also include any or all of the 3 levels of planning: short range, medium range, or long range. Financial forecasting involves applying assumptions to model future events based on past performance numbers and current trends. This method of predicting the future based on previous and current data is often referred to as profit and loss forecasting, or P&L for short. There are multiple ways in which this can be done, but incorporating the systems and ratios we've just discussed provides the data for a strong P&L report, which should be revisited on an annual basis. Financial models, such as the one we've discussed, make it much easier to predict the results of any changes made to either income or revenue or expenses, costs. They also serve as an effective tool for analyzing the effectiveness of past marketing campaigns, product launches, price increases, etc. Nonprofit organizations must go through similar calculations to earn money and pay bills like for-profit organizations. Financial models are not only used to help determine the financial health of an organization, but to also forecast their cash flows, break-even points, and other elements that contribute to the overall success or failure of a business. Financial management is often overlooked by many people when talking about small businesses, yet it is one of the most important aspects in order for them to succeed or to fail. Financial management may be overlooked by people because they do not realize just how much this affects every aspect of running a company in day-to-day life. Financial management helps companies understand where their money goes and helps them see what needs improvement so they can have more cash in hand. Some of the basic rules for forecasting include examining data for the presence or absence of a trend. The farther out the forecast, the less reliable the forecast. Older data is less important than recent data. The last actual value of the forecast variable is the most important piece of information. Financial forecasting templates help businesses and organizations plan out months in advance for their expected expenses and income. These templates help organizations gauge what type of funds they will have left over at the end of that period. For example, an organization may expect a large increase in donations one month, so they can use their P&L reports to help with their financial planning. Financial forecasting templates like P&L sheets are usually created in Excel or Google spreadsheets, so that organizations can always have access to them and use them if needed. Using P&L reports as part of your organization's process to project all its future cash flows and revenues and expenses will help come up with certain figures such as how much money it will make by the end of the year, what are the monthly expenses, and so on. This information is then used to see if an organization will be able to pay off its own debts and potentially expand. Risk management in financial management is used to reduce the impact of financial risks that may cause problems with the performance of your organization and its mission. Financial risk management is very important for nonprofit organizations because of limited resources and market fluctuations. Nonprofit organizations especially need an efficient way to manage their finances, which includes a wholesome understanding of the financial aspects involved in running a business. This doesn't mean that you have to be a professional accountant or a finance expert, but it does mean that as a manager, you should understand some basic accounting terms and principles so you can make sound decisions with regard to your company's money. In order to effectively manage finances with your nonprofit organization, there are many variables that you should take into consideration. Financial risk management can be challenging for nonprofit organizations because their financial stability may not be as strong as for-profit businesses. Nonprofits also need to meet many competing demands, including serving clients or meeting changing needs in the community, overseeing projects, expanding services, and diversifying revenue streams. Nonprofit managers must therefore manage these threats by making prudent decisions about cash flow and investments that will not jeopardize the future of the organization. These precautions also help increase public trust in nonprofits by showing what they are using and how they're using those funds responsibly. Some issues to take into consideration when it comes to fees include direct and indirect costs, depreciation and use of allowance, unallowable costs, profit margins, fixed and variable costs, break-even points, market prices, and variable fee and sliding schedules. All of these variables should be considered in your overall financial analysis all the way through your profit and loss reports. Government contracts and grants to examine in determining revenue streams can include federal, state, and local government resources, contracts, grants, and cooperative agreements, procurements, RFPs and IFBs, and private contracts. Government contracts and grants can provide a steady stream of funding for an organization to survive the ups and downs in the private sector. The budgeting process, tracking financials, and knowing where revenue comes from is key. Financial management for organizations requires a combination of leadership, communication, transparency, practicing good bookkeeping habits, and staying organized so that all components are accounted for. Properly engaging in financial management will create a sustainable business model. Many nonprofit organizations rely on government contracts or grants as their primary source of income to keep an operating balance. Organization leaders should know the basics of how governments fund projects and what makes a grant versus a contract. There are differences between these two types of funding that impact how the organization will receive its revenue and complete its project. Government contracts are used when an organization wants to do specific research for a client or contractor who is paying for the work done. Grants are typically given by governments because they have identified a social need that needs research, education, or other projects. Government grants are usually awarded based on need or interest in researching a topic about which there is little information available. Nonprofits may have expertise in areas where public institutions have limited capacity. RFPs, or requests for proposal, and IFBs, invitation for bid, also called an ITB or invitation to bid, should also be understood by key decision makers in the organization. Organizations should be clear in their program's purpose and overall function to convey services effectively for contracts or grants, and then be able to communicate it clearly to government agencies offering funds. Leaders should know what research is needed for their projects and make sure they are familiar with the basics about how governments fund projects. Foundations or philanthropic organizations can also be explored to diversify your organization's revenue stream to include foundation grants, exploring types of foundations that may have a broader reach, chronicle of philanthropy, other development approaches in fundraising, or entrepreneurial development. When it comes to auditing, a few resources you should be familiar with include the American Institute of Certified Public Accountants, the Comptroller General of the United States, Office of Management and Budget, and Code of Federal Regulations. Some major types of auditing you should also be aware of for organizational financial management should include pre-audits, financial audits that include financial statement audits and financial-related audits, program-specific audits, grant and contract audits, performance audits, which include economy and efficiency audits and program audits, and single audits. Here are some additional resources to further your reading, and now let's open up for discussion. What has your experience been like when it comes to nonprofits, organizations, or even agencies when it comes to financial management?